Hi, my name is Gervais, Chief Economist at Farm Credit Canada, with a brief commentary on the decision of the Bank of Canada to leave its policy rate unchanged today at 2.75%. Now, there are plenty of risks in the economy. There's no shortage of factors that suggest that the Canadian economy could slow down over the next few months and until the end of the year 2025. Take, for example, tariffs set by the U.S. government today on Canadian exports of aluminum and steel. Those tariffs are expected to lead to a slowdown in some sectors of the economy. Global supply chains remain on high alert. The tariffs, trade disruptions are likely to raise the cost of doing business, lead to higher consumer prices that could slow down consumption, so forth. So plenty of reasons, in my opinion, to think that the Canadian economy is going to slow down between now and the end of the year. Now, if you look at the data, though, the data has been quite resilient. Canadian GDP in the first quarter of this year went up 2.2% on an annual basis. It beat expectations, but that's mostly the result of an inventory buildup, and as well exporters getting ahead of anticipated tariffs. And we do expect that those two things will likely lead to a slowdown in production and a slowdown in export sales throughout the rest of the year. Inflation has been resilient. Now, yes, inflation, most recent inflation data points suggest that inflation has fallen to 1.7%, but that's mostly the result of the removal of the consumer carbon tax. If you look at the preferred inflation measures of the Bank of Canada, core inflation measures, some of them are above 3%. So inflation has been quite resilient. So there was no real basis for the Bank of Canada to lower its policy rate today. Nonetheless, we continue to expect that the Bank of Canada will have to cut its policy interest rate before the end of the year. We expect that we might go from 2.75% today all the way down to 2% by the end of 2025. Now, the one thing to watch is what will happen to Canadian long-term interest rates. Those interest rates are largely influenced by what is going out south of the border, and the fiscal situation in the United States has created quite a bit of volatility and has raised some questions about the future path and trend of long-term interest rates. So expect short-term interest rates to fall between now and the end of the year, but keep an eye on long-term interest rates, as this is not far from certain that those long-term interest rates are going to follow the same pattern as short-term interest rates. For more information, I encourage you to go to our website at fcc.ca/economics.